Hello, hello, everyone. This is Hannah Chapman, your host, and today is Thursday, August 9th. It's currently 1:18 p.m. Pacific time to put a timestamp on it. And this is another episode of Investment Friday. I am here on my own this week. Brad is out with his family for this weekend, so send him all of the good vibes for having a great family weekend. He did tell me, so we didn't have an episode last week because I was out of town last week, and I'll share a little bit about that. But Brad did tell me he did try to record on his own, but he's never recorded a podcast episode by himself before, so he did not feel confident with it. And so that's super fair. So we will continue to just boost his confidence that he can do it. In the event that I can't record, it's really great to be able to still have those updates go out for what's going on with the economy because there's a lot of stuff that's going on right now in the economy. Like I said, it's October 9th, so we've got some, planning, tax planning things to start doing, year-end planning things to start doing. And in the midst of all that, we have had a government shutdown here in the US that started on October 1st. So it's currently October 9th. We are still in this shutdown, and the markets have been fine, really. They haven't really responded negatively to anything that's been going on. We've been hitting record highs still over the last couple of weeks, mainly due to the fact that we are still expecting more interest rate decreases. We got our first interest rate decrease in quite a while. At the end of September at the last Fed meeting, and the markets are expecting another couple, potentially two more rate decreases in the next couple of meetings here. So when investors see that, when companies see that, as we've talked about plenty of times on the podcast, um, that really changes how much financing costs. And a lot of businesses really run on outside financing for whatever they might need it for. And so when their interest rates go down, that spurs on more economic growth. So that's what we're seeing in the markets right now. But with the government shutdown in particular, one of the things I wanted to mention about that, two things really. If people are concerned about that or worried what it will do to the markets and your portfolio and all of those things, historically, there has not been a real correlation with what the government shutdown does or how long it lasts, and any significant market movement. In the 1980s and 90s, we had a few really brief shutdowns. They would be a couple of days, a few days at most. Um, the longest shutdown, here's the example that we have. The longest shutdown before the 2010s, so this was in 1995, 96, was 21 days with, President Bill Clinton and Newt Gingrich as the Treasury Secretary. And it didn't really affect the markets that year. 2013, we had another 16-day shutdown. And the S&P fell a little bit in that first week. It had some volatility, some worry about um, if it was going to put too much pressure on the economy at that time. But and that was all part of the Affordable Care Act discussions as well, which comes back into play this year, actually. But it recovered. And by the end of the year, the market was up more than 10%. So we really didn't have any appreciable things to be worried about in 2013 either. 2018, 2019 had the longest shutdown in history. That was 35 days. And the markets were already super volatile at that time because there were Fed rate hikes going on. We had concerns about trade wars going on. This was during President Trump's first term. And even with all of the uncertainty and concerns about lots of geopolitical issues at that point, the S&P 500 still rebounded. 2018 saw a really, December 2018 rather, saw a really sharp sell-off in the market. If you go back and look at historical records, and we did see within that shutdown, we did see the S&P 500 return back to the norm. So that wasn't really like there weren't a lot of um, negative consequences for the stock market when we look back at previous shutdowns. So if we look at it from that lens, we don't expect much in the way of, what's happening with the stock market with this shutdown either. But there are a few other things that I wanted to kind of talk about with this particular shutdown. So one of the big issues that we're talking about, and that is on the docket of this shutdown, part of this budget discussion, are the enhanced tax credits for the ACA, also known as Obamacare, also known as the Affordable Care Act, also known as the marketplace, quote unquote, when we say, if you go to the exchange to get your health care, or rather health insurance, um, if you are, either self-employed, and again, I have a lot of self-employed clients myself, so I do have a lot of clients who utilize the health insurance exchange to get their health insurance. Or if you work for, a very small business that doesn't provide health insurance and you have to go to the exchange, um, those are all part of this discussion. So anyone who does have their health insurance through the ACA, most people that have health insurance through the ACA receive a subsidy. So that means they are getting a credit, a pre-loaded or a front-loaded credit for their health insurance cost when they sign up and when they go through open enrollment. Open enrollment starts November 1st this year, so it starts in just 3 weeks or so. For people who do have to get their health insurance through the ACA. And one of the big, big concerns is that if these enhanced tax credits expire, which they are set to do, they are set to expire this year, um, that could drive people's premiums up double, 100%, in some cases, even like 200 to 250% higher than what they're paying right now. So that could look like someone who's paying $500 a month, their monthly premium goes up to $1,000 or $1,500 a month. Or a family that's paying $2,000 a month is now expected to pay $4,000 a month for their health insurance coverage. For a lot of families, that's really not sustainable at all. Like that, it just isn't possible. But that's what the enhanced credits have enabled people to do. They've enabled people to get health insurance coverage without spending, 25, 30% of their total annual income to do so. There have been a lot of increases from insurance companies lately as well. I think the average premium rate increase from insurance companies themselves, like the average across the board is like 18% expected for 2026. So not only are we, expecting, if these enhanced credits don't get, what do we say, renewed, that people will have to pay more because the tax credits are going away, but they'll also have to pay more because insurers are raising their premium rates as well by an average of 18%. So this is a really significant issue, and it can be a hard thing to have to like sift through and figure out especially when you are a small business owner, or a self-employed person who has to get health insurance on your own. So that is something that we are watching. There's no movement right now, again, because the government is still shut down, and this is part of the discussion that is in the bill, right? It does cost money to provide those credits, so we have to find that money from somewhere. So yeah, that's if you are currently getting your health insurance through the ACA, that is something I just want you to be aware of. pay attention to, when the exchange opens up or when the open enrollment period opens November 1st. That is definitely something to just take into account and to know when you see it, you'll just have to kind of see what options are actually going to work for you. And in some states, just depending on where you live, the increases might not be as significant. So I just wanted to put that there as a piece of like awareness, not to be afraid, but to be aware of something that could be a significant change for next year when you start to do some of your budgeting. Um, and I truly hope that overall the credits do go through and that people who need health insurance can still get affordable health insurance that doesn't cost, 25% or more of their annual take home, because that is, again, pretty much like the word that comes up for me is egregious. Like it should not cost that much money for individuals to get health insurance. But I digress. Um, the other aspect of that, of the government shutdown, is that when the government is shut down, we stop receiving statistics from the government agencies that typically run all of our economic numbers. So if I go over here, a lot of the numbers, that we typically look at, we want to know what are when we talk about the JOLTS survey, for example, the job openings and loss numbers. So we want to know how many jobs are there, how many people are unemployed. That's a big indicator for the economy that comes from the Bureau of Labor Statistics, uh, currently shut down, right? We also need to know what the inflation data looks like, and that comes from the PCE and the CPI, the personal consumption um, expenditures, and the CPI, the consumer price index, right? Like those are the big ones that we look at. Those come from the government, also the Bureau of Labor Statistics. So with that being shut down, we have to look to some of our other private sector firms and platforms so that we can have that real-time economic data and to still be able to make decisions that we need to be able to make. So one of the places I just wanted to give people a few, like, if you're into the data and super nerdy and like me and like Brad, and want to know where some of this other data is and where we can find it, one, you can look at ADP. They do so much of the data processing for payrolls, right? I literally have clients who use ADP, and they have all kinds of different experiences, whether you like using them or not, for your own business processing, payroll processing and whatnot. But regardless of personal experience, they are one of the largest payroll processors in the world, right? So they have a lot of data. So we use ADP data to find, some of that employment data. And they really provide monthly insights into private payroll trends, sector level breakdowns, wage growth, all of that. So we can get some of that data from ADP. Visa and MasterCard also give us a lot of data on consumer spending. So even if we can't go to, the PCE or the CPI, we can't see those numbers from the government, we can look at some of the reporting that Visa and MasterCard do that tell us about consumer spending trends. Um, and they also tell us, how much people are taking on in debt, how quickly people are paying off credit card debt. And it really, like the other thing, one of the reasons I use this data personally, mostly with my Visa cards, I suppose, they give a really good breakdown of how you're spending your money. So they're keeping track of what you're spending on travel, what you're spending on food, what you're spending on, consumer goods, what you're spending on education. If you use your credit cards or debit cards for any of those purposes, that's being tracked internally by Visa and MasterCard. So we get really good insights there as well. You can look at, a place called Homebase for small business statistics, hourly wage metrics. Homebase also talks about your real-time tracking of hours worked, employee counts, small business closings and reopenings. That is one of the places that, like we might expect to see statistics from the SBA, the Small Business Alliance Association, SBA, either way. We get to see that information from Homebase instead. When we talk about home buying, real estate trends, you can kind of get some of those from like Redfin, Zillow, places like that. Um, Not necessarily in the same way that we would get from like a more overall report, but we can still go and search local trends. You can certainly look at your own home and see how that's going. Anyway, so there are a lot of places. Oh, and then the last one I wanted to mention that we talk about a lot on the podcast is trueflation. And Brad uses this all the time when he's talking about inflation, for sure. So it's called trueflation. And that one is different from the inflation readings that we get from, the CPI and the PCE, because that actually takes into account, I think it's like 40 million consumer products and services that people are paying for, and takes like real-time snapshots of what people are paying right now across 40 million different data points. And so it's consistently updating every day what things are looking like on that day versus, whatever time frame you want to look at, versus 1 year ago versus 1 month ago, whatever that looks like, or whatever you choose to measure. So the trueflation numbers are also, again, something that you've probably heard us talk about quite a bit. Data, the reason I'm saying this is because the stock market really does trade on data, and it needs good data. Like, traders need reliable data in order to be able to forecast what they think is going to do well in the future. So having reliable data is super important. So even though the government is shut down, and we do tend to get some pretty big aggregate data from the government on, weekly, monthly, quarterly, annual bases, we still have these private firms that we can look to for this data that we do really need. The next thing I wanted to talk about today and pivot to a little bit for education topic is tax planning. So again, it's October 9th. I have had quite a few clients, ask me questions for 2024 tax processing because they may have, what's the word? Oh my gosh, I'm losing words. They filed an extension at the beginning of the year or in April of this year, and the extension ends October 15th. So for anyone who filed that extension, October 15th deadline is coming up pretty soon. So if you have a question for your CPA and they're not quite getting back to you super fast, it's probably because they are working on all of the extensions that they have to now get finished before October 15th. A few things I wanted to say here. So if this is you, if you filed an extension and you are now in this moment of, okay, we're getting our numbers back. I see that I owe money for this year, or for last year, really for 2024. There are still some things you potentially could do. Not a whole lot, but there are a few things that you can do up to and including the extension deadline, in order to lower your taxes if you would like to do that. Now, again, we're getting really close here. This is going to post on the 10th, so you're only going to have like a couple of business days to take care of anything. But let's say you already have a traditional IRA open, and you ask your CPA, can I put, money away into my traditional IRA to lower taxes? That could be an option for you. If you are able to do that, for IRA, I'm going to just look up the IRA contribution limits. If you are under age 50, you are able to put up to $7,000 into an IRA if the other conditions all, if you meet all the other conditions for being able to contribute. So I'm not going to spell those out in detail right now. That's definitely something you can either ask your financial planner or ask your tax preparer. But if you're under age 50, again, $7,000. If you are married, you could potentially also do $7,000 for your spouse. Again, as long as all the conditions are met. So that could potentially be $14,000 that you could put into a traditional IRA, which is then going to lower your tax bill. Let's say you're in the 24% bracket. Okay, let's say that's you end up in the 24% federal tax bracket. Let's say you put $14,000 into IRAs, one for you and one for your spouse. That means you're going to lower your your tax liability rather. So let's say you owed, I don't know, $25,000 in taxes. And okay, you're gonna put this 14K into IRAs to avoid some of that. That will then come back and save you $3,360. So that $25,000 in taxes comes down to 21,640. Okay, so you just lowered your tax liability by $3,300 basically, which is great. It's not nothing. And it's from my perspective as a planner, if you have the cash available, or if you have the ability to move it without any other tax consequences and it's easy, if you've already got that cash available, then you are saving towards your future. You are saving for yourself that $14,000 and you're keeping an extra $3,300 that's not going out to taxes. So it's a double win in my book when I see someone who can accomplish that. The other accounts that you can still fund up to the deadline, you can also do this with a SEP IRA, that's SEP. And this one can be quite a bit more. It can go up to, let's say you're a self-employed person, you have a SEP IRA for your business, you're a solopreneur, and let's say your taxable income was $200,000 for the year last year. That's your net to you, right? So maybe your business made 500, 600K, you kept 200. You can potentially put right around 20% of that into a SEP IRA up to a certain limit, up to around $70,000. So if you have $200,000 of your taxable income, that's what you get to keep as taxable income, you could potentially put about $40,000 into a SEP IRA. Again, there are some calculations. I'm being super general right here. So you have to, go to your financial advisor, go to your tax preparer, ask them if this is possible for you, and what your max contribution would be. But again, if you have that money set aside, if you have $40,000 that you have in cash somewhere or in an investment account that you can move it over easily, that will, save you will be saving that $40,000 for yourself. And let's say you're in that same 24% bracket. If you're in the 24% federal tax bracket, that actually saves you $9,600 off your tax bill. So it saves you almost 10 grand off your tax bill to give yourself $40,000 into that SEP IRA. So there are other accounts that we can look at with this, right? Like there are a couple of other specific things that you could look at, but I just want you to know if it's time, like if you're listening to this on October 10th or 11th, and you're like, that's me, there could be time if you already have these accounts set up. So get on the horn, talk to your financial advisor, talk to your CPA, see what's possible. See if you can save yourself a little bit of taxes, money going out in taxes, and keep it for yourself instead, and let it grow for the future. So if you don't have those accounts open, it's probably a little bit too close, and this is a really good thing for you to have in your awareness for next year. Okay. Because a lot of times when people do file extensions, it tends to be like that tends to be your tax cycle anyway. So if it's likely that you're going to file an extension next year as well, just know that these are options that you have that you're going to want to plan for. You're going to want to be able to ask the questions ahead of time so that you can make the right plan for your tax mitigation um, and retirement savings. So I'm going to also say here, I also have a lot of clients who don't like the term retirement, don't really resonate with the term retirement in general, and that's fine too. So why would someone who doesn't resonate with retirement as a concept want to do any of these strategies? It's literally the tax play. That's 100% the reason why you would want to do this is to defer taxes to a time where your income that's influxing will likely be less, especially if have other investments or you create other pools of investments that pay you differently um, and it's not as earned income, right? Like there are all kinds of different ways that we can create income strategies. And in the future, if you fund these quote unquote retirement accounts, which are really just tax qualified accounts, is what they're called by the IRS, is that you are deferring your tax payments to a later date. And then you can choose. You can choose when you're 59 and a half or when you're 65 or when you're 70. You can choose when you start taking money out of those accounts to some degree. And hopefully at that point, you'll be paying less in taxes then than you are now. That's one piece of it. The second piece of it is that that money will also grow tax deferred. So any different investments you make inside your IRAs, or your 401k for that matter, a few different things. Any investments you make inside of those accounts, you don't pay current taxes on. So that in and of itself is also a long-term benefit and helps your money grow faster because it's not being taxed during those years while it's growing. Okay. That's a really, really important benefit that a lot of people don't take into account when they look at like, why would I want to put that money away now? Right? That deferred growth, super, super important. Um, another option you do have if you can't contribute to a traditional IRA for any reason, or if you just have the ability to contribute to a Roth IRA or a Roth type account, that also, you also have that ability here at before the tax deadline on October 15th, um, if that's the way that you choose to go. And a Roth account is similar insofar as like it is not a current tax deduction. You're not going to save money on your taxes this year if you do a Roth in any, whether it's a 401k or an IRA or a SEP IRA or any of those. You're not going to save money in the current tax year, but it will also grow tax deferred. So that's one of the special things about the Roth IRA. It will grow. You will not pay taxes on the growth the entire time that it is growing and sitting and working for you, not just sitting, it's working for you that whole time, as long as it's invested. And then when you go to take it out in the future, it's fully tax-free. So that's also a really, really great account. If you've worked with your financial planner and you see that the Roth accounts are a better option for you, for example. So with that, I say all of that to say that there are still a few options right now. If you are literally doing your taxes right this moment and you have a financial advisor and you have these accounts that you can potentially fund at the last minute here. If you already did your taxes and you finished it in April, this is still the season, kind of starting here in October, where we start to do reviews and we start to do some forward, both tax planning for 2025 and starting to look ahead into 2026 a little bit. So, what are some of the things that we're looking at before December 31st, because that's our next deadline. There are some things that have to be done before December 31st to count as a 2025 tax deduction. Okay. So we want to just kind of figure those things out, at least, in the next couple months. If you wait until December and wait until December, like second half of December, you're not gonna be your CPA or your advisor's like favorite person in that moment. But most of us will try our absolute hardest to get those things done for you. So my encouragement is to have this discussion now with those people and not wait until, like the third week of December. For example, there are some people that will flat out say like, no, we're not doing that as well. But those would look like your charitable donations. If there are any philanthropic things that you want to take care of in 2025, that needs to be done usually before December 31st. So if you want to give, but give back to your school, if you want to give to a religious organization, if you want to give to a charity of your choice, um, all of those things are really, really great to start planning now. And of course, having known plenty of people who are on the boards of charities and nonprofits and different things, they also really appreciate when they know a little bit ahead of time, or, they're not waiting till that December deadline either. So that's definitely something you can look at right now. Different types of gifts. We can maybe talk about this in a later podcast. I don't want to go into it today, but different types of gifts also have different types of taxation. So that will be a really good topic. So if you give cash, say you have literally cash in your account and you're like, I want to give this place $10,000 or $50,000 and just write them a check, that is one kind of donation. And it has a limit on how much of it can be deductible based on your income level. And we'll go over some of those details. The other kind of gift is, let's say you bought some Apple stock back in 2001 and it's appreciated by, I don't know, 10,000% by now. And so let's say you have $50,000 worth of Apple stock and the cost basis is $5,000. Okay, so you've got a $45,000 gain on this chunk of Apple stock, and you're like, well, what if I donate that? Well, if you sell that Apple stock to then write a check for $50,000, you have to pay the capital gain, that $45,000 capital gain, right? Or you have to pay taxes on that $45,000 capital gain rather, which depending on your tax bracket could either be 15%, um, which, gosh, let's do 45 times. So $6,750 of tax on that sale, or it could even be 20%, which is going to look like $9,000, right? If you're in a higher tax bracket. So you don't want to sell your highly appreciated stock so you can write a check. That's not the way to do that. Instead, you want to donate that highly appreciated stock as is to that organization. Then you don't take that tax hit. And then the charity also does not have to pay taxes on that gain either. But also, again, that's subject to certain limits. So I want to just place that information here, but we'll go into more detail on that in a later episode, because I didn't prepare for that, and that's kind of where my brain went. The other thing you can also, donate are uh, goods of some sort, like appreciated goods or antiques, things of value, like something you might donate to a museum, something like that. You can donate those kinds of things as well. Those also have a different tax treatment to them. One thing you cannot donate, just so you cannot donate your time. You cannot say, I'm a consultant and I'm donating my time to this organization and it's worth, $15,000 for the time that I spent with them. The IRS does not recognize that as a donation, so it's not going to work. Don't try to do that. It's not going to get you anywhere. It's beautiful, and if you want to give that time to someone, you absolutely should if that feels right to you. Um, but yeah, it's not going to be a tax deductible thing if you give of your time and efforts. So, um, before December 31st, again, like any of those charitable gift type things need to be set in place by December 31st. A few other more sophisticated things that we could also put into this category would be, charitable lead or charitable remainder trusts. You can look those up. There would either be called a CLAT or a CLUT, CLAT, charitable lead annuity trust, or CLUT, charitable lead unitrust. A charitable lead trust is where you put money into an irrevocable trust. So for all intents and purposes, once you make this donation, it's done. You can't undo it. Um, Technically, there is a way out, but you have to pay all the taxes back. So if you want to do this for the tax donation, you make this deposit to an irrevocable trust called a charitable lead, or a charitable remainder. They're two different things, but the charitable lead trust means the charity gets to use and the income and interest and whatever parameters you've set, a charity gets to use that over time until you die. And when the grantor passes away on a charitable lead trust, whatever is left of the chair of the trust, called the corpus of the trust, that gets passed back to the beneficiaries. So let's say your grandpa does this, creates this charitable lead trust. The charity is using it while he's alive. He passes away. Whatever's left in the trust then gets passed down to his heirs as spelled out in the trust. So maybe that goes to his children and grandchildren or somewhere else. A charitable remainder trust, on the other hand, um, goes the opposite direction, where again, let's say grandpa puts the the amount into the charitable remainder trust. It's an irrevocable trust. Can't make any changes to it once he does this, or she does this. Grandma can do it too. And it will pay grandma and grandpa, or mom and dad, or whoever, it will pay them every single month or every single year, however they set it up, a certain percentage. And so they have an income stream that they can rely on that's also not in their estate technically. And then at the end, when they pass away, the charitable remainder means that the remainder goes to the charity. So the charity gets to use and gets that money at the end of their life when they pass away. Both of those can have pretty significant current year tax deductions, depending on how much you put in, what you want to do with that, how you want to set it up. So that's certainly something that you can consider, but I never, ever, ever recommend that for anyone where that's not like, yeah, we're going to do that with a portion of our assets, and we still have all of these, have plenty of other assets to sustain us otherwise, right? So this is a tax play and a charity donation at the same time, right? Like, so it has to be the right fit for your economic situation, for what your overall assets look like, and for your intentions of how you want to see your money impact the world. Um, those are some of the things that we need to be looking at right now in this Q4 of the year, now that we're in October. We can look a little bit at, and when we do tax planning, when I do tax planning with my clients, we're looking at how much have you made so far this year? How much have you saved for taxes so far this year? Or how much have you paid in, right? If you have a payroll service that takes out a certain amount out of each paycheck, we want to like just gauge all of that and make sure you're on track in case you have to make some extra tax payments or do a little extra saving at the end of the year here to be prepared for April of 2026 to pay 2025 numbers. One thing that has happened to me and my family, and has certainly happened to other clients before. And I would encourage everyone to actually go do this, is to go and check any withholdings that should be happening. So you want to, if you have any W-2 income, you want to make sure that the appropriate amounts are being withheld so that you don't end up with a like really overly surprising tax bill when we get to April of 2024. Um, for me, that like, many years ago, that looked like um we just didn't check my husband's W-2 to see like he was paying taxes. We saw that it was being withheld. No, I'm going to take that back. He switched jobs, I think mid-year, and in the new job, for some reason, they didn't actually like institute the tax withholding. So it was a mistake in the HR side, but we didn't catch it. And that was really surprising. And it doesn't feel good. You're like, how did I miss that? Because other deductions were happening. We just didn't look at it. So definitely check that. I had another client recently who she has payment processing. She's a small business owner and didn't realize that her payment processor that she's using right now, they didn't have tax withholding set up either. Um, this was before she was working with me. And when we, like that's a thing that we look at of like, let's make sure that your withholding is happening the way that you intend it to. If you purposely don't withhold and you save instead, like that's your choice, or you don't withhold and you pay quarterly estimates, like you can choose to do those things. I just want you to make sure that you are doing the thing that you intend. So if you intend to be withholding from your income on a weekly, biweekly, monthly basis, that you're withholding. And if you don't intend to be withholding on a biweekly, monthly basis, and instead you intend to be saving, that you're actually doing that. Me personally, my husband has a W-2 job, so he is, and we do know that he's withholding the right amounts now. But that's forever since that mistake many years ago, we have always been super diligent about making sure that he's withholding the amount that he needs to withhold. And then I save into a tax account every single time I get paid. So I save 25% off the top of my income. I put it into a tax hold account that earns, I don't know, it's like around 4% right now. So it's earning money throughout the year. And then at tax time, we've got some that's been put away through W-2, and the withholding on his W-2 income. And then we've got my tax savings account that I have been saving into all year long. That is a piece that we work on. When I work with entrepreneurs, this is how we set up tax savings so that you know that you are always going to be okay when you are front loading your tax account. Okay, so not even necessarily front loading, but it's just you're staying on top of it. And I have seen firsthand and secondhand how, like how scary it can be when you are like dropped with, a 5 or 6 figure tax bill that you're like, I was not planning on that. I don't have that right this very second. I can sell more. I can go get that. Like I'll get through it, or we can do a payment plan, right? Like there are ways around it, but it doesn't feel good. And so that is absolutely one of the things that I just encourage my clients with. Like we work diligently over time to get to the place where you can always be ready for your tax bill, and find the ways to reduce it ethically, legally rather is maybe the better term. Yeah, to legally reduce the taxes that you owe. So you're not, skirting any laws or making yourself a target for getting audited. That's not something I ever want my clients to experience either. So we tend to stay, I personally tend to stay on the more conservative side, um, just to make sure my clients are going to be safe. But there are always things that we can do to mitigate taxes if you have reserves on hand, if you have cash on hand, or the ability to, you have time where it's like, okay, yeah, I could sell another package, I could sell another thing, and then have that cash available before that deadline to be able to, do some of these different savings or donations or whatever it is, tax strategies that we're looking at. So this is October 9th. This is a good time, or October 10th when you're hearing this. This is a good time to start making those plans for either I have the cash I need, or I can make a few new sales. I can do some, get some new influx of income so that I can have myself prepped and ready and feel really good when it comes to, being ready for tax time. And I recognize, again, personally too, like I don't necessarily like paying taxes, but it is something that I don't want to run afoul of the law and go to jail or have any of my clients pay stiff penalties or go to prison over taxes, right? Like that just feels like such a dumb thing to me to be worried about. So anyway, that's what I wanted to share. And then, oh, last thing, very last thing for today that I wanted to share is also that this is also the time where we're starting to look at the required minimum distributions for our clients as well. So if you have an account that requires that you take money out of it, this would be a traditional IRA or a SEP IRA or a 401k if you are at RMD age. So typically this is going to be clients who are in their 70s or older. And you have to take money out, or the other population is people who have inherited IRAs. So I have several clients who, their parents have passed away and they received an inherited IRA from their received their um, traditional IRA from their parent. And so now it's an inherited IRA that also has its own RMD rules that go with it. They're also complex. They're not perfect. This is not to say this is a complete rundown on what you need to do for inherited IRAs. But if you have an inherited IRA, you need to talk to your financial advisor if you have one, about how much, if you need to take any out and how much you need to take out. Um, I can dive into that a little bit more on another episode as well, because there are some new rules that have happened lately. But just know if you have an inherited IRA, highly encourage you to speak to a financial advisor about how much you are supposed to take out of that inherited IRA so that you don't end up with like ridiculous penalties in the next couple of years. I think the penalty for missing your RMD is 50% of the RMD. So let's say you had to take 15,000 out and you didn't, the following year that penalty would be like you would have a $7,500 penalty for not taking out the $15,000, right? So it's dumb. We don't want to miss that, um, and have that be a thing that you lose money on just because, and pay extra taxes that you really don't want to pay. So if you have a traditional IRA and you are in your RMD years, we want to make sure we get that done before December 31st. And if you have an inherited IRA, you want to talk to your financial advisor, and see if you need to take out an RMD. And that also has to be done before December 31st. So that is our show for today. I miss Brad. I love having him to go back and forth with. It's more fun than recording these by myself, but we're all good. And hopefully that was helpful for you to hear about what typically happens with government shutdowns, and then what we are looking for when it comes to tax time and tax planning. Um, Oh, bonus. I forgot to mention this. This was on my list of things to mention. Tax loss harvesting. We've talked about this on the podcast before, so that's probably why it slipped my mind a little bit. We have talked about this. It is a process by which we look at what has, how the portfolio has either grown or shrank during the year, if certain investments have gone up a lot and certain investments have gone down. If you have losses that you can harvest, that's something that we want to pay attention to, especially in this fourth quarter. At Juncture Wealth Strategies, we do that all throughout the year. We don't wait until the end of the year. We do active tax planning throughout the entire year. So it's not, yeah, whenever people come to us and ask, like, well, do you do tax loss harvesting? The answer is yes, and it's always. We don't have a process at the very end of the year that's any different than what we're doing all the way throughout the year, because we're always paying attention to where the gains are, and where the losses are for our clients. But that's not the case. I have been at other firms. I know that that's not the case everywhere. So that is something that you can ask your advisor about, and just ask what their process is. I wouldn't necessarily ask, do you do tax loss harvesting? Because that's kind of a remedial question at this point. It's more, what's your process? And just asking that is going to allow them to tell you if they do it, how they do it. And if they do give you like a, I don't know what that means, look, then yeah, that's a question to ask, maybe someone else, if you're looking for someone new. So tax loss harvesting, also very important, also something to start paying attention to, at this time of year, especially, Q4 here, if it's not something that's been going on throughout the whole year already. Um, yeah, those were all the things. A little bonus in there. If you have any questions, if you have any, thoughts about anything that we share here on the podcast, or you have a specific thought and question and want to punch it over, I would love to hear from you. You can email me at hannah@expansiveceo.com for the podcast. And all of our contact information is down in the show notes. And overall, I hope that everyone is going into this last quarter of 2025, um, feeling okay. I know this year has been very volatile. We've had lots of ups and downs and uncertainties and all those things. But hopefully things are starting to feel a little bit more grounded. You're starting to feel like you can keep creating even amidst the chaos and uncertainty, and that we are here for you every step of the way. Thanks for listening. We'll see you next time. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, @expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.